Hello everyone, I'm John V, founder and CEO of Agency's Wealth Management. And in today's episode of Between Two Funds, we have Nicholas Economides, Professor of Economics at Stern School of Business of NYU. How are you, Nicholas? How's everything?
Good, thank you.
What do you believe that that investors should do now that everybody says that, hey, I want to move to all cash? What is your suggestion? Should the investors that are thinking to move to all cash actually do it, or should they try to ride the market?
I think we're facing very significant volatility. Sometimes the market is down, sometimes it's up. But for non-professionals, people who don't spend their whole day doing financial stock market transactions, for those people, it really doesn't make sense to play actively the market at this point, to sell or to buy at this point. Why? Because for every one of your clients who thinks he knows, there are 20 people in New York, in Wall Street, who know better than him. And when all these sharks are swimming, you try not to swim. You don't swim with the sharks. You try to take it easy, keep your portfolio goals as fixed, and ride it out. I mean, wait until there is calm in the market, which might come in a month or might come in 2 months, whatever it comes. But it really doesn't make sense to come in and out because you're not a professional, and therefore you have a very hard time understanding what's the optimal strategy. It's very, very hard.
Makes absolute sense. What is your opinion overall the stock market, the U.S. stock market during these volatile times?
Well, I mean, look, in the long run, the stock market always does well. And even in the medium run, if we're talking about 6 months from now, if we keep steady, it should be recover and be higher than it is right now. I'm saying this not as financial advice, of course. I mean, you have to think of all the caveats. Don't hold me responsible if it doesn't go up, okay? But I think that this is probably what's going to happen. At the same time, we should keep in mind that the closure will create most likely 2 bad quarters for the U.S. economy. So we're talking about minus 20% for quarter 2 and minus 20% in quarter 3, which means approximately minus 10% for the whole year. But the government is already spending 10% of GDP. So if it turns out that it's going to be minus 20 the second quarter, minus 20 the third quarter, then the money that the government has already spent in the stimulus package is going to be sufficient to bring us almost to zero. Now, additionally, the government is planning this week to approve a bill of $500 billion more. So that's extra money. So if that is spent, then we're going to be, and if we are at only minus 20, then we're going to be able to have a positive growth for 2020. So we'll see how it goes. The important thing that people should keep in mind is that besides the fiscal stimulus that the federal government is already putting forward, the 1 trillion plus the $500 billion more, there is the Fed, and the Fed has provided unlimited liquidity to the market, and I really mean unlimited. So what does unlimited liquidity mean? It means that the interest rate is zero, and that it can intervene in many, many, many markets which might have a problem because of constraints, because price falls too low, or for whatever reasons. There could be a whole bunch of reasons. So in some way, when we start recovering, even if it's a month from now, 2 months from now, 3 months from now, this 0% interest rate of the Fed is going to be very, very useful for growth in the United States. And I have to say that compared to other regions and countries in the world, the US through the Fed has done exceptionally positive, has taken exceptionally positive measures.
Oh, yeah. What do you believe about the global economy? I know that everybody talks about how US is handling the whole situation, and we have Fed that can literally print money. But what happens with the rest of the rest of the world?
Well, they also can print their own money, but what I'm afraid though that Europe, which started before the coronavirus in a mild recession, is only spending so far 5%. The Eurozone is only spending 5% of GDP for the coronavirus, which is totally inadequate. I mean, here we said we're already spending this huge amount of money, 10% plus more. Okay, so they're spending only 5%, which is not going to work. So they have to put their act together in Europe, in the Eurozone, and spend at least twice as much as they have budgeted. Presently, they have budgeted about €500 billion. They need to spend over $1 trillion, and some people say $1.5 trillion to be comparable to the United States. So if it's going to happen or not, it's hard because the European Union is not integrated enough and doesn't have tax revenue to support a Eurobond. So there might be all kinds of other reasons why it cannot have a Eurobond, but maybe the most fundamental one is that it doesn't have its own tax revenue, European Union-wide tax revenue to be able to do that. So there are institutional hurdles for the Eurozone. But the reality is so harsh that they will have to do it. Sooner or later, they will spend a comparable amount to the United States. As for other regions, China has its own stimulus. The Chinese are very difficult to predict what exactly they're going to do, but in general, they have been pretty responsive to weaknesses in the economy. So if the weaknesses show up, they will spend more money.
What do you think that financial advisors in the US should be doing right now?
Well, I think there are two jobs for financial advisors. The first job is to be better in helping the clients with psychologically. A lot
doing actually the psychologist, like literally.
Yes, you have to get a degree in psychology. So because the clients, like everybody else, are scared, and not only they're scared for their lives, but they're also scared of their savings. And this is unprecedented. Every day the TV blares the numbers of the dead, so people are scared. They say, what's going to happen with my savings? So it's important to reassure them that this is an exceptional short period of a few months that is going to pass, and therefore they're better off not changing their general strategy. And that, in fact, if they do change their strategy and start getting in and out of the market or out and in, it could hurt them. It could hurt them substantially. They might lose substantial amounts of their nest egg by doing that. So that's one part. The second part as an investment manager is to be confident himself or herself that it's going to follow the general objectives of the client and keep investments that have the appropriate level of risk that the client desires, and also not try to do anything crazy because you are a financial advisor. Try to do the stuff that you're telling the client not to do. So it's important to stay the course, and it's important to be steady and keep in mind that financial performance is judged not day by day, but year by year, or maybe 5 years by 5 years.
It's a long-term game. It's a marathon. It's not a sprint. Yeah.
Exactly.
Yeah. And one final question: which is not actually relevant to economics, but it's one thing that I ask almost every one of our guests at Between Two Funds podcast is what do you do? What's the first thing that you do every morning? For example, a lot of our guests said that the first thing I do when I wake up is grab my phone and check my email, check my Instagram, check the stock market. So what's the first thing that you do?
Okay, the first thing, and that's really the first, is make a double espresso. Because without a double espresso, all these numbers don't mean that much. You really need to wake up sufficiently to be able to think. So that's what I do, and then, of course, check the email, see how the university is doing, see how the financial markets are doing, and also see how the epidemic is progressing in New York, and the numbers in the last 3 weeks have been encouraging. Like we reached the peak, and now we're in the lower part of the number of admissions to the hospitals, which really drives the whole thing. I mean, drives the death and everything else. So we're kind of near the end of the epidemic in New York. I mean, we're not really at the end, but we are, within weeks. Yeah, we're going in that direction. The direction is correct, and I'm optimistic that in a month or so there will be more openings. I mean, I'm sure that the states that are going to open are not going to be New York. I mean, first, but eventually New York as well.
Of course. Perfect. Thank you a lot for finding some time. I know you're super busy. These times are very volatile. Thanks a lot for joining us here at Between Two Funds. And thank you everybody for watching and listening to. See you at the next episode. Thanks a lot, Nicholas.
Thank you.